Okay, good morning and welcome back, everyone, to our monthly options thematic investing series. This month, we're going to be talking about the future of healthcare. And I do apologize to those of you who received an email saying that this session was going to be at 4:15 this afternoon. We normally do these at 8:30 a.m. I know quite a few of you are used to that time and you've jumped on. But if you're just joining us because you received an email letting you know that the time has changed, it is because of an error on our side, and I apologize for that. But we will make this available with the recording and the slides to everyone if you do miss it. So let's go ahead and get started. But before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off, like I said, talking about the healthcare industry, specifically regarding the digital health industry that has really taken off as a result of COVID-19. Now, largely what we're going to do is we're going to show you trends that have already been in place even before the pandemic, but talking about the acceleration that we have seen since the pandemic and how you can gain exposure to the shifts towards digital healthcare, mobile healthcare, e-healthcare going forward, and the types of companies that are exposed to this shift in the way we deliver healthcare. So we'll talk a little bit about the overall industry, the changes and trends that we started to see in healthcare and what specifically in mobile healthcare, which has been I would say the largest accelerator here in 2020. And even though to some degree, early in the pandemic, our views were that those were largely transitory gains or more temporary gains, what we have seen now after a full year of the pandemic is that many of these gains are more likely to stick for the long run. So we want to talk about the e-health stocks and the mobile health stocks that fall into this particular category. We'll talk both the technicals and the fundamentals of each one of these types of companies, show you those outlooks and research, and then open this up for Q&A here at the very end. So the primary question that I want to help investors answer from today's session is, what are the primary investable themes for healthcare for the next 5 years or so? Can everyone hear me? If you can, please type yes into the chat window. Okay, perfect. For those of you, you might have to turn on your sound or enable audio in order to listen to this. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and me and my team have taken a deep dive into the telehealth, e-health, mobile health industry to bring you what are the relevant big picture trends that we have seen emerge, and largely have been in place even before the pandemic, but simply have been accelerated by the pandemic, and understanding as to which one of these trends will likely continue and how to position and gain exposure to these particular trends, either through an ETF or through specific companies that operate in specific verticals of this particular space. So first, it really comes down to number one, the population boom, and a few other factors that we're going to show you here. But the biggest, I would say, driver of growth over the past couple of years with respect to COVID is mobile health. Mobile health meaning the delivery of healthcare services through a mobile app. Now, there's exposure not only here to the US, but globally, and a fairly even, I would say, growth in this particular space, not just here in the US, but globally. The other one is digital healthcare systems, because for mobile healthcare to work, a lot of the healthcare systems need to be digitized. So those are the two primary trends that we see have emerged, or we see very strong conviction for over the next 3 to 5 years with respect to digital healthcare. Telehealthcare, which was effectively non-existent in 2018, we expect to be fairly sizable, but the growth in that is still early days, and it's not exactly clear as to how long or how much that will be. So this is one of the things that we want to um, be aware of when we're investing in this, that some of these trends that we have seen during 2020 and 2021 may become maybe just temporary. They very well could shift, just going back to where we were before. So it's important to understand these trends and understand which ones are sticking and which ones may be more permanent. But one of the reasons that we want to take a look at healthcare is not just because of the trends that we have seen in terms of the growth in revenue, the growth in usage, but also from a valuation perspective. Medical technology is currently trading at a fairly significant discount in terms of valuations relative to the S&P 500. Um, Largely over the past decade or so, on the lower end of the spectrum, medical technology stocks have traded at about a 10% discount to the S&P 500 in terms of forward PE. And the peak, which was around December of 2018, right before the what we call the taper tantrum, or when the Fed started to look at raising interest rates, that traded at about a 25% premium to the S&P 500. So right now we are at the bottom end of the range. So from a valuation perspective, especially in this current market, where valuations are extremely stretched by pretty much any measure across most sectors, medical technology remains one of the sectors currently that is trading at a relative discount to the S&P 500, which makes finding companies that are trading at relatively lower valuations a little easier, especially in the tech space where most names are trading at very, very stretched valuations, and make it difficult for long-term investors to buy stocks that are trading at such rich multiples. So taking a look at some of the trends. So as you can see, when we talk about digital healthcare, pretty much since before the pandemic, we have seen trends moving in the right direction across the globe. North America is by far the stronger market here with respect to digital healthcare. But as you can see, since the pandemic, globally, pretty much every single region of the world, Asia Pacific, Europe, North America, we have now seen digital health account for more than half of the healthcare that has been provided here during 2020. So a huge acceleration in a single year that probably would have taken another 3 to 4 years to reach the levels that we're currently at with respect to the share of market of digital health. Now, the question is, does this trend continue at the same pace it moved in 2020 and 2021, or does it start to slow down, uh, decelerate, or does it potentially even start to come back to normal, back to trend a little bit? This is really the question for a lot of investors in this particular segment. And that's why we need to pay attention to these trends in the next couple of quarters. And we have specific names that we'll talk about here today, specific stocks that we can use as a proxy to gauge whether consumers are shifting towards digital health in a more permanent way, or is it just as a temporary solution during COVID, during the pandemic, where there really are not any great alternatives to it. So this is something we can capture quarter by quarter using some of the companies that we're going to talk about here today. So as far as the shifts in electronic healthcare, what has been driving changes towards digital healthcare, a lot of it comes from, and this is something that we talked about in our recent 5G and IoT thematic investment series, but really technology innovations that allow for this, whether it's the ability to monitor healthcare, health vitals, if you will, digitally and remotely, the FDA approvals, the emergency FDA approvals that were granted during COVID-19 that allowed medical technology companies to provide the devices that allow us to do this, but also, some of the life. Some of the trends that we have seen in terms of diseases, specifically diabetes and hypertension, with respect to heart disease and diabetes, two of the major contributors of healthcare costs here in the United States. And the different monitoring, the different healthcare and medical technologies that are needed in order uh, to deal with these two specific diseases that are very prevalent here in the United States. So those are some of the things that you really have to pay attention to when you're investing in this particular sector or subsector of the market. But we also see rising healthcare spending from the government. We'll talk a little bit about which types of companies have a large exposure to government spending in this particular space, as well as just a rising population is, with limited resources and a rising population, this is going to cause a need for digital healthcare that's more scalable, especially in regions of the world and in the United States that are more rural, that do not have strong healthcare infrastructure. Digital healthcare steps in as a form of care that may not be accessible locally. But there are some restraints here, and it really comes down to a lack of infrastructure in quite a few places, and the amount of healthcare spending that is provided in some of the emerging economies and countries. So we will talk a little bit about that, but this is really some of the trends. These are some of the issues that have caused this trend towards digitized healthcare. Whenever you have lack of infrastructure, healthcare spending where costs is extremely, where healthcare is very cost sensitive, digitized healthcare has a better value proposition. The other thing we will also want to consider here is data security and privacy as we talk about moving your healthcare records to the cloud, to mobile platforms. Companies need to step in to, number one, consolidate all of this data so that different providers can have access to it, but also around security. This is something that certain companies specialize in, and that we'll talk about here today. But with respect to mobile health, this is what has accelerated the most in 2020 during COVID-19. And this is everything from just being able to have a healthcare check-in for something that's non-emergency using anything from Zoom to an app on your phone. This is where we've seen a lot of growth here in this particular year. And while at the end of 2020, our expectations was that this was going to start decelerating and start returning back to normal, we have not seen those trends. We have actually seen these trends accelerate here in 2021. So this is why mobile health is one of the fastest growing sectors or subsectors of this particular presentation and the different companies that specifically operate in this space. But technology has been a big driver of the ability to do this. Everything from the Zoom platforms that power the digital sessions to the wearables technology that now allow us to monitor a variety of health vitals for healthcare providers across the world, and even 5G, the communications networks that are enabling more real-time monitoring of healthcare vitals in a way that is suitable for medical use. So all of these things are contributing to the growth that allow mobile healthcare to thrive. And even though it's been trending in the right direction for multiple years, 2021 has been the almost like hockey stick moment for all of this to come together and start to grow in the future. And that's why it's one of the industries that we want to look at here today and understand where can you get exposure, what type of companies can you utilize to get exposure to. And the first place to start, as we always do with our thematic investment series, is to look at ETFs that give you broad exposure to this entire subsector or entire theme that we're referring to. So the leader in this particular space is an ETF called EDOC. EDOC is the digital healthcare ETF. Now, there's about 30 stocks in this particular ETF. It's suitable for those of you that perhaps may not want to do the research or maybe feel that you're better off just getting exposure to the whole industry as a whole. Being able to do it through a single ETF like EDOC is a suitable way of going about doing that. They currently have about $730 million in assets, which is significant enough for us to talk about. The average market cap of the 30 stocks in this ETF is about $17 billion. And they focus specifically on stocks with a high amount of exposure to telemedicine and digital health. And it runs a pretty wide gamut of stocks that fall into this ETF. I recommend, if you're going to invest in an ETF like this, to look at the holding companies, understand what you're investing in when you buy an ETF like this, but it really covers a pretty wide swath of telemedicine, healthcare analytics, which is a big segment of this, and we'll talk a little bit about the companies that are in that space. Connected healthcare devices, the true medical technology companies that provide the devices to monitor everything from glucose to your heart rhythms. And administrative digitization, which is the fact that as we move towards digital health, there needs to be a one single source that all of these digital health providers can go to access your health records in a secure way. So all of these things have to be in place for this trend to continue, and we're going to talk about the companies that operate in this particular space. So the first one, which is probably arguably the most visible since the start of the pandemic, is Teladoc. TDOC, many of you have heard of. I've traded this on CNBC for those of you that followed me on this particular trade over the past couple of quarters here. This is the most visible name, I would say, in this particular space. They are the largest provider of virtual healthcare services here in the United States at the moment. And really, it comes down to the convenience of telehealth, and the lower cost of it has seemingly replaced in-person healthcare for a lot of users. Currently, they have about 51 million paid members that have access to Teladoc as a service, and they have in last year 21 million fee visitors, meaning visitors who paid a one-time fee to access a Teladoc appointment. So what's very, I would say, interesting about this particular company is that on a general scale of the different companies we'll look at today, it's relatively small in terms of revenue, 1.37 billion in trailing 12-month revenue. It trades at a fairly rich multiple for a health company or healthcare company at 16 times sales. But I would argue that this valuation of trading at 16 times sales is actually fairly reasonable, if not almost inexpensive, for the type of valuations we typically are seeing for fast-growing tech companies. And because for those of you that have joined me from my thematic investment series over the past few months, you have seen me talk about stocks that trade at very, very ridiculous valuations, 20, 40, sometimes even 80 times sales. And they're simply not growing very fast at those valuations. But Teladoc has averaged, last year in 2020, they had about a 98% revenue growth in 2020. So double revenue in 2020 versus 2019. 2021's looks like it's going to be still in the high 80s in terms of revenue growth. So towards the end of last year, I believe it was Q3 earnings where I took a bullish view on Teladoc. And by Q4, we were already questioning whether the trends that we saw in 2020 were going to be sustainable towards next year. And despite having a big move to the upside above the $240 level, which had been a range bound, the stock had traded range bound between 180 and 240 for many, many months, broke out all the way to 300 and quickly reversed all the way back here to the 180 level, which is the February sell-off we saw from tech shares. And since then, the stock has actually continued to break below this trading range and has now touched all the way as low as $130 just a couple of weeks ago. So from $300 to $130 in the span of a couple of months. So significant collapse of multiples on this particular stock. So this is a stock that was trading at about 30 times sales just a few months ago, is now trading at half of that, 16 times sales. So this is really where I think from a valuation perspective, it starts to look a little interesting, given the fact that now you're able to buy this stock at a valuation that's significantly cheaper than it was even about a year and a half ago, but has now had doubled the revenue since this time in early 2020. So we're talking about a valuation that looks far more attractive based on the current growth rates that Teladoc still commands at this moment. It is certainly decelerated a little bit, but we're talking about a fairly small amount of deceleration, certainly not the reversal that many investors were concerned about towards the end of last year. So, and the other thing to think about here is that, a lot of these fast growing mobile health and Teladoc companies that have kind of popped up as a result of the pandemic, none of them are close to profitability. Teladoc is going to generate roughly $40 million in free cash flow in 2021, and over 200 million in free cash flow in 2022. So significantly better path to profitability, given that it is the largest player in this particular space. And right now they have acquired quite a few brands in the telehealth space that they operate, some of the most visible brands in the mobile and telehealth space. So this is one that, like I said, is the poster child, if you will, of digital healthcare. And we can use the revenue growth from Teladoc as a proxy for, are consumers continuing with this trend, or is this trend just temporary and starting to reverse? And the data so far, and at the end of 2020, the beginning of 2021, still shows a strong acceleration in terms of revenue, and the fact that the stock has pulled back by 50% here over the past couple of months allows investors to now potentially enter this stock, in my opinion, at a much more reasonable and potentially even cheap valuation for a company that is at the very forefront and with the largest exposure to digital health. The second company we want to talk about is Laboratory Corp. This is one that is probably not on anyone's radar with respect to telemedicine or digital health, but it is one of the larger healthcare companies, $15 billion in revenue over the past 12 months, trades at a very reasonable 12 times forward earnings. So a very, I would say, inexpensive from a valuation perspective. Again, like I said, medical technology at the moment trading at a fairly significant discount to the S&P 500 with respect to multiples. So, and this is one that really, like I said, flies under the radar. They are one of the largest clinical laboratory testing services in the US. They pretty much do most of the routine testing that's involved with patient diagnosis and monitoring and treatment of diseases. But they've also seen a significant growth in terms of COVID-19 testing, which is what has been accelerating their revenue growth, because over the past 5 years, they have pretty much averaged a very steady 5 to 7% revenue growth. Nothing to really write home about. It's not a household name. Most investors are in this because they have an ETF that has exposure to healthcare that invests in companies like this. But we are seeing a significant acceleration in that revenue growth, 20% expected in 2021 after almost 5 years of just single digit 5 to 7% revenue growth here. So we've seen this huge acceleration, and it's part of why we've seen the stock break out above 200, coming back to retest this level of support late last year, and the stock has really taken off here. And it really comes down to the fact that they're building diagnostic tools and systems using digital healthcare systems to try to eliminate errors with respect to testing, and especially with digital health, making it more convenient and cost effective for consumers to reach to get healthcare. This is likely going to increase the amount of routine testing that is done here in America, where in many places where it's not accessible or it's very expensive to access a doctor, people may just simply not go for annual physical checkups. So with telemedicine, we expect that there is likely regular routine healthcare will be administered more regularly in a more cost-effective way, and that will lead to more of the regular routine testing that patients need during their annual physical and whatever diseases and treatments that they need for that. So again, this is one of the companies that really flies under the radar, but we've seen this acceleration in 2020 and 2021 to their revenue growth. And not to mention that our expectation is that just simply growth of COVID-19 testing will likely stay for a little longer than many investors had anticipated. A lot of investors in stocks like Abbott Laboratory, which is another big COVID testing stock, those our expectation many times was that that testing was largely going to trail off after the vaccine was going to get rolled out, but so far we're not seeing that. We're seeing testing remain fairly strong, and expectations that testing will remain strong for many years to come. So COVID-19 testing certainly providing a bit of a boost to their top line growth, in addition to the benefits of just general routine testing that we expect will grow with the advent of digital healthcare. So Laboratory Holdings, interesting play there. The next one I want to talk about is CERN. CERN is a fairly sizable and leader in what we call healthcare information technology. So when we talk about teledoc, we talk about mobile healthcare. This is all driven by the fact that your health records are becoming more and more digitized, and they need to live somewhere in terms of how electronic health records are stored and accessed by the different providers that need access to it. And if you think about your health records, they really need to be accessed by a large number of entities, everything from your doctor's office to nurses to lab technicians that are running tests, pharmacists to prescribe the right drugs, insurance companies, and even you as the consumer to access all of those records. That all needs to sit somewhere. So CERN Cerner sits at the platform level that aggregates your healthcare data and provides it and provides access to all the different parties and organizations that need access to it. Now, from my perspective, this is something that is this is a company that does trade at a relatively rich valuation, at least for what I consider is relatively flat revenue growth. So this is a company that currently generates about $5 billion in revenue, a little $5.5 billion in revenue over the past 12 months. It trades at a 29 times forward earnings, so 29 times next year's earnings. Not particularly expensive, but for a stock that has seen zero revenue growth for the past 5 years and about a 7 to 8% revenue growth in 2021 and 2022. This is some of the I would say that the valuation on this is fairly rich for a company that's growing at a, I would say, reasonable revenue growth. So 7 to 8% growth is not something to really write home about in terms of yearly revenue growth. It certainly doesn't rival the 80, 90% that Teladoc is growing at, but it is an integral part of the growth of digital healthcare because your health records need to live somewhere, and platforms that are working with a wide variety of organizations and insurance companies and hospital groups to provide this platform that secures and aggregates your healthcare data and provides it available to all the different parties that need access to it in a secure way is certainly a company that you need to look at if you're investing for this particular space. Now, what's sort of interesting about Cerner is the fact that they are also trying to provide professional services. They're also trying to provide analytics on this healthcare data to governments, to insurance companies, and monetizing that data in a different way. And that's part of what allows us to trade at a slightly higher multiple. So instead of just a healthcare company growing 5 to 7%, which largely is not particularly interesting for investors and certainly doesn't command a high multiple. But when you talk about being able to provide analytics, when you start talking about providing um, uh, data to insurance companies that they can utilize to optimize care, that's really part of why this company trades at a slightly higher valuation. From the chart perspective, as you can see, not a particularly interesting chart, just a very slow and steady growth here of the chart itself, trading near the top end of the range. So this is one from a technical perspective, not the most, I would say, attractive out of all the names that we've taken a look at so far, but certainly one of these steady players in this particular space and worth taking a look at, again, if you're investing in this particular space. What is, I think, steady about this company is the fact that they have been able to grow their revenues significantly from the US government, both the US federal government and Veteran Affairs. 18% of their revenue is currently derived from the US federal government, of which last a couple of years ago it was only about 13%. So we've seen a pretty significant growth in their ability to secure US federal contracts. And we expect that that is actually going to continue to grow in the next few years as, again, digital healthcare requires these types of technology solutions to really power them at its core. And then let's talk a little about some of the specific med tech companies, the companies that actually provide devices to facilitate digital healthcare. So ILMN is certainly one of the smaller players in this particular space, but an interesting side of the medical technology space. A very small company, $1.37 billion in trailing 12-month revenue. This trades at a very expensive 63 times earnings, especially given the fact that we've seen revenue decline in 2020, but we do see some pretty strong revenue growth here for the past 3 quarters, 15% revenue growth for the past 3 quarters alone. So that's going to translate to close to 60, 70% year over year revenue growth from 2020 to 2021. That's part of what's making this company look fairly interesting, technically speaking, also very interesting from the perspective recently breaking out above this 375 level. This is a stock that has been range bound since June of 2018 from this 275, 375 level. It broke out above this level, hit a high of about 550, and now has come back all the way back to this resistance level as support. So we've now touched 375 multiple times, and the stock has held 375. So risk to reward perspective looks attractive here for longs because 375 is only roughly $30 from where the stock currently is. Upside is fairly substantial. So the risk to reward looks fairly attractive given the fact that it's now bounced off this 375 level twice and has held that level as support. Now, this company develops and provides not only the machines, but also the services around genetic testing. Everything from and the primary business that they were in prior to COVID was prenatal and cancer screening using genetic testing. So and this is a company that has a 80% market share in this particular space. So anything in the medical field, and this is a fairly, I would say, growing aspect of the medical field of using genetic testing to screen for prenatal diseases, cancerous diseases, using genome sequencing. They produce the machines that do the genetic sequencing, but they also provide the services around the testing kits that are actually sent out to users to swab someone and get back the genetic material that they use to test. And also, what's interesting is that COVID-19 has driven a lot of the need for genetic testing. This comes down to the new variant strains. As many of us are acutely aware now that COVID-19 has multiple varieties of strains of COVID-19. And in order to figure out what strains they are, it requires genetic testing. So this is one of the companies that have provided the devices and the testing kits in order to test a large number of samples to determine which variant of COVID-19 a patient has. So this is a fast growing segment of the market. This is a company that have largely been in business since 2010. For the past 5 years, the revenue growth has not been particularly strong, has not been, I would say, attractive for a lot of investors, but having the 15% quarter over quarter revenue growth over the past 3 quarters has really brought this stock back to life. And technically speaking, the breakout here above 375, rallying to that 550 level very quickly and coming all the way back to retest this level of support and holding that level twice is constructive, in my opinion, for a longer term outlook. This stock does trade at a fairly rich valuation, so for those reasons, it's something to be a little bit concerned about, right? I think this is the type of stock that you want to allocate a smaller amount of capital to because of how rich the valuations are. But based on the potential outlooks, worth considering for your portfolio. The next one I want to take a look at is Dexcom. Dexcom, we talked about during our 5G and IoT session as a medical application of continuous health monitoring. One of the few companies that provide medical devices that are FDA approved for continuous monitoring. Now, this is for diabetic management. This is a company that trades at a, again, very rich valuation, 146 times earnings. Currently, generates about $2 billion in trailing 12-month revenue. So fairly small player as well. But they are one of the leaders in providing and manufacturing what we call continuous glucose monitoring systems. So for those who have diabetes, to monitor glucose, historically you have to prick a finger, put that blood on a strip in order to test glucose. They have a device called the G6, which recently had FDA emergency approval during COVID to do remote continuous glucose monitoring. This has really been the driver of revenue growth for this particular stock. But for considering the fact that it trades at very rich valuations, it at least has revenue growth to back up some of that. In my opinion, not enough revenue growth to justify 146 times earnings, but 20 to 25% revenue growth in 2021 is expected. And this is a company that trades not at medical technology valuations. It really trades at what we call tech valuations because of the fact that they have worked with different companies to provide what looks like a scalable technology platform for the future. And what I mean by that is they have used their continuous glucose monitoring systems and integrated it with automated insulin delivery. So this has applications that I think are significantly larger than what their current revenues imply. Being able to effectively administer insulin on a automated basis if they're able to monitor glucose remotely. They have a cloud-based data platform that they use the data to sell to insurance companies. And they have a partnership with a lot of the major pharmaceutical companies and Alphabet Research, Alphabet meaning Google Research. So they have built a fairly interesting technology aspect of their company. And it's not just a diabetes monitoring a company that they have built, and that's part of why the company trades at very, very rich valuations. Now, this company, if you look at the chart, has been largely range bound between 320 and 440 or 420, depending on how you want to draw the lines. Right now, we're very much at the bottom, near at the middle of the range after bouncing off this 320 level here just a few weeks ago. My expectation is that this is likely going to be more range bound going forward. So right now is may not be the best opportunity to go long this particular stock, but if you do see this bounce back towards the 320 level, that would be an interesting play for this particular name. And if we see a breakout here above 440, that would be likely a significant upside that we would expect on a name like this, especially after the stock rallied from about 160 to 320 after then spending what is pretty much a year range bound. So if we break out from 440, we would expect that this would project closer to about $600 to the upside on a breakout of this continuation pattern to the upside. So the and you know what could potentially drive that there? First of all, their G6 product was approved by the FDA for emergency approval during COVID for remote monitoring. This was one of the first products to be approved for remote monitoring of glucose. And they expect their new product, their G7 product, to launch the second half of 2021. So there's a lot of, I would say, interest from um, investors in the approval of the G7 product, which would allow Dexcom to continue to grow their um, their product line within this particular space. Now, it is just for those of you that are unfamiliar with this specific segment of the market, Dexcom is by no means the only player in this particular space. Medtronic and Abbott Laboratories are two major players that also are in the glucose monitoring space as well. So Dexcom, while having an interesting story and having the FDA approval for the G6 product during COVID, there are other players in this particular space, which for me as an investor, when I see these types of valuations, and the fact that they're not a single player and they're not the only player in this particular space, the revenue growth here is decent, but not very, very strong. I do have some concerns about buying the stock at these specific levels and these specific valuations, even though I like this company as a theme. So that's just a warning label in terms of the valuations that it's currently trading at. The next one I want to take a look at is Boston Scientific. So from a company perspective, very similar to Dexcom, but Boston Scientific largely providing medical devices that are in the cardiovascular space. They actually provide a pretty broad range of medical devices, what they call minimally invasive medical devices. But their largest group is their cardiovascular business. And number one cause of death in the United States is health disease. So 44% of their revenue comes from medical devices that are designed for cardiovascular diseases. Now, this is a company that also, from a company perspective, not very interesting. Revenue over the past 5 years have been largely flat, but we have seen a significant acceleration here in 2021. We expect them to close out 2021 with a 20% growth in revenue after 5 years of being relatively flat. And if you look at the chart itself, the stock is pretty much sideways. But if you want to look and zoom in a little bit, pretty much this stock was on a pretty strong, I would say, pretty clear uptrend prior to the pandemic, broke down below that trend, and has basically traded up to this $42 level or so, $42 level, and finally broke out above it just a few weeks ago. And it's come back to retest this level as support. So technically speaking, you have a very interesting entry point right now where it's retesting a major resistance level now as support and may continue moving higher, especially on the growth in revenue that we're expecting in 2021 that have not materialized over the last 5 years. Now, they have a pretty expansive pipeline of technologies, specifically regarding diagnosing and treating coronary artery disease and other heart conditions. They manufacture everything from stents to pacemakers to different medical devices used to treat heart disease. They have pretty much um, a very wide portfolio of medical devices to treat this very specific number one leading cause of death here in the United States. They also have other businesses here as well, but I think the fact that they have a fair amount of exposure to cardiovascular disease is what makes this an attractive company, especially since it trades at relatively inexpensive valuations compared to Dexcom that we just talked about, even though they operate in very different spaces. As a company, they're very similar. This also currently does substantially more revenue than Dexcom, about $10 billion in revenue. And with roughly the same expected revenue growth in 2021, trading at 25 times forward earnings, from my perspective, looks far, far more attractive. Now, again, just like Dexcom, Boston Scientific is by no means the only player in their space. Abbott Laboratories and Medtronic both compete with Dexcom and Boston Scientific very heavily in all of these segments that they operate in. So while these are not the only companies that operate in this space, these are two companies that do have specialty that we think are interesting to take a look at, especially with a lot of these medical technology companies have seen very little revenue growth over the past 4 or 5 years. And Boston Scientific, Dexcom have not been on the radar for most investors in the medical space because of these reasons. They simply were not growing. But COVID-19, the acceleration we've seen during the pandemic, has really shifted the revenue growth for many of these companies. And we're starting to see revenue growth that is looking like it's going to be sustainable going forward. And for a company that has had zero revenue growth for 5 years, to accelerate that to 20% in a single year, it makes it interesting enough to take a look at. And interesting enough to take a look at from a fundamental perspective. The technicals on Boston Scientific also look fairly interesting after breaking out here a few weeks ago and now retesting it as support. And with the 20% revenue growth trading at 25 times next year's earnings, that also, from a valuation perspective, looks fairly attractive here as well. So all around, looking at these types of names, you have hopefully what is an interesting view into how the digital healthcare space, or the different types of companies that operate within the digital healthcare space. And this is by no means a exhaustive list, but this gives you a good spectrum, if you will, of the different types of companies that operate in this particular space and how you can go about evaluating them, thinking about them, and deciding whether it's suitable for your portfolio for the long run. So with that, I want to thank everyone for taking the time out here this morning. Again, I apologize for the confusion of the start time here, but hopefully most of you know that we normally start these at 8:30 a.m. That's exactly when we started this morning. And I just want to thank everyone for taking the time out here this morning. I hope that this was helpful in giving you a better understanding of the digital healthcare space, the mobile healthcare space, and the different companies that operate here as well. So with that, what I'll do is I'll open this up for Q&A here for a couple of minutes. You have a chat window and a Q&A window. If you don't mind putting your questions into the Q&A window, and I'll try to answer as many questions as I have time for here today. Roger is saying FIGS had their IPO this week. It's in the healthcare market. Can you discuss your thoughts on this company? So I really don't think FIGS is a healthcare company. It's an apparel company. They make apparel for healthcare professionals, but I don't think of it as a healthcare company. My understanding is that it's been doing quite well on the IPO, but it's an apparel company and it should trade at apparel company valuations. There's not enough information for me to look at just yet on this particular company. They have very little data to look at, basically 31 million, 87 million revenue. So what looks like very strong revenue growth, but 2 quarters does not make a trend. So we're just going to have to see. But a company that probably trades at a very expensive valuation, I would guess. It trades, I just don't have enough information yet to make a decision, but I don't think of it as a medical company. It's really an apparel company. What companies are building apps? I would say the biggest ones that are at least you can publicly trade is Teladoc. They have acquired a lot of the companies in this particular space, and is really the only way to get access to this side of them, to get access to mobile apps through the public markets. The other one is really through the ETF that I was showing you, EDOC. EDOC has a portfolio of companies that operate in this particular space here as well. So Teladoc and EDOC are the 2 ways, in my opinion, to get access or exposure to that. Comment on MDXL. I have no idea what MDXL is. So this looks like a penny stock or an OTC stock. I certainly don't follow any of those, and I generally have not traded any OTC stocks. Would you consider Abbott Laboratories? I think Abbott Laboratories is interesting because they do a fair amount of COVID testing. And the stock recently pulled back here to this 115 level. So breaking out, pulled back twice to this level. The question is whether it'll hold and bounce higher. I think the fundamentals do potentially warrant a potential bounce here for this name. And I think that the risk to reward looks favorable for a long on Abbott Laboratories, because even if you target conservatively 125, 128 here to the upside, and you cut your losses below the 200-day moving average, the risk to reward here looks far more favorable for a long than a short. Medtronics. Medtronics, similar to Abbott Laboratories, and especially if you look on the weekly chart here, also very interesting. Recently breaking out above this 120 level, is now pulling back here. It's not quite, it hasn't quite gotten back to this 120 level yet. I think that if you do see a pullback towards 120, that makes it a far more attractive entry for a long. So Medtronics I like, but I don't particularly love the entry point at the very moment. Any healthcare ETF that you would encourage and focus on? I really think EDOC is an interesting one to pay attention to. And maybe I forgot to take a look, show you guys the chart here or comment on the chart before, but EDOC pulling back to this $18 level. You see, this is a major level going back to even, towards the end of 2020. We've now tested this $18 level twice and it's held. So entry from a risk reward perspective looks very attractive on this particular ETF at the moment. Clove, I've never heard of Clove. I really just know nothing about this particular stock, but it does look very similar to most of the SPAC names. Basically broke below a major support level. which is around the $10 level. It's now traded back up to this level twice and has now broken another support level. Well, actually, it looks like it's managed to get back above that support level here. So this is a stock that's currently range bound between 10 and 7. My expectation is probably likely that this will continue to trade within this range. Cameron, no, we are no longer short Roku. We already sent an alert to get out of Roku. Comment on LabCorp versus Quest. I think those two are very similar to each other, but Quest. Quest Diagnostics looks very similar to many of the names that we talked about here, largely range bound, broke out recently, came back to retest these levels as support. Quest has very similar, I would say, look and feel to LabCorp that we just talked about here. So pull back here to this level is, I think, constructive for an entry point, especially from a risk reward perspective. Comment on Regeneron. Regeneron's chart does not look particularly strong, but it did recently break out above this downtrend here, right? So you have a very strong downtrend. It broke out above it. It's now retesting it as support and potentially has the ability to continue here. But another way that you can look at this chart, which is not as favorable, is that this is a stock that's in a strong downtrend. We're in a continuation pattern here. And if it breaks lower here, it's likely going to continue moving lower. Now, I don't know much about the fundamentals of this company, and that's probably what you're going to need to make a decision as to long-term, whether you think the stock is headed higher or lower. But the chart here looks like it's fairly in this consolidation range. And if you do get a break below this range, that would target lower pricing for Regeneron. What is a good ETF candidate for this sector? As I said before, EDOC, EDOC is the ETF. They have about $780 million in assets in this, and it's all digital healthcare space. Your question about the support or resistance lines drawn on the OptionsPlay tool, those are support and resistance lines. So we calculate support and resistance lines for stocks, and we'll show you whether how far the stock needs to rally to hit that next support and the next resistance level. ARC-W has Teladoc Holdings. Are you a fan? I'm a fan of Teladoc. ARC-W has a lot of things in it. And I don't particularly love all of the names in many of the ARC names. I think most of them are overvalued. Would EDOC be a leap candidate? It certainly could be a leap candidate. Pretty much all of the names that we talked about here are leap candidates. But I do think that the ones that are trading at a lower valuations are better leap candidates. Nilesh, we've recently posted a blog post on how IV rank is calculated, so you can find that on our blog on our homepage. IDEX is in the pet care industry. What's your feeling on it? I don't know anything about IDEX. IDEX Laboratories. If this is the healthcare, the pet testing company, they do, I just don't know anything about this, but the stock is trading up against this 560 resistance level, hasn't broken out higher yet, but is making higher lows. That is a potential sign that it may break out, but I don't know enough about the fundamentals of this company to comment on the fundamentals. How about a leap on Teladoc? I think leaps on Teladocs is a reasonable strategy to use for that type of company. Any seasonality impact on this space? Not that I'm aware of, William, but I also don't have the data to necessarily look in. I don't have the data to look at the moment to say yes or no. What are your thoughts on Amazon in the healthcare space? So Amazon certainly, with their Amazon Pharmacy, I think is a risk to companies like CVS and Walgreens. But it is also going to be a relatively small percentage of Amazon's revenue, where it's not going to have a material exposure to healthcare, at least not in the short run. So for those reasons, I don't think buying Amazon purely as a healthcare play is the right play. I think there are plenty of other reasons to buy Amazon, and if healthcare certainly helps your thesis or helps your conviction on it, that makes sense. But it's going to be a small percentage of their revenue. Um, Umesh, if you want to find out about the indicators on my chart, please send us a question here on the questions ask us section on the platform, and we will help answer that question here for you. Okay, with that covers the questions that I have time for here today. Like I said, thank you so much for your time this morning. I hope that this was helpful in giving you a better understanding as to how we're positioned here within this particular space and how we're thinking about the trends in this particular industry. So with that, we're going to wrap up here today. I will send out the recording with these slides so that you can take these and do your own research on each of these companies before you think about investing in them for the long run. With that, thank you so much. I hope you guys have a great Friday, a great long weekend. Remember, I am off next week, so I'm not doing a Tuesday and Thursday session, but I will be back the following week. But on Tuesday and Friday next week, we will be sending you a chart book so that you can still follow the markets and understand how we're viewing the markets at the time. With that, thank you so much and have a great trading day.